alternative or private or illiquid credit is an asset class that has been growing at an extraordinary rate since the financial crisis. Now, once again, I think it might be useful, perhaps even a little bit instructive for the audience to know a little bit about, a little more perhaps than they might already about who you are and what you do. Nicole, why don't you tell us a bit about yourself and MV Credit?
Great. Good morning, everyone, or good afternoon, I think. MV Credit, well, we've been in the European credit markets now for about 18 years. I think we're the kind of the longest running management team. Our kind of thing is very credit based, so we have been providing credit to the sponsored middle market in Europe for the last 18 years, doing that very successfully across a number of cycles. So we were direct lending back in 18 years ago, before direct lending was a word. And we continue to do that. And the market is growing. A lot of what you heard in the previous panel is true of the private markets in Europe generally, which is the general debanking and therefore the move for more lending from asset managers like us.
Dwight, Blackstone is a firm a few people in the audience might have heard of, but they might know less perhaps about GSO and specifically the range of activities GSO undertakes.
Well, I thought we were the famous part of Blackstone and the rest of it followed. So I run part of Blackstone, the credit side of Blackstone called GSO Capital. We manage about $100 billion of credit-oriented investments and yield-oriented investments across a number of different strategies. The reason we have a different name is we do a lot of lending to other private equity firms as part of the history of our business, and that's how our business has really grown over the years in this private debt world, and we see all the same types of growth that you talked about, the opportunities that we talked about. It'd be interesting, I think, if you could get all of us in a room and in each a separate room and ask us what the middle market is, because it is such a different description depending on who you're asking.
Well, we heard the last group define what the middle market is. Why don't you take a stab at it?
Sure. Well, we always defined ourselves as middle market till the unitranche providers came up, and then we started to call ourselves upper middle market. So really, for us, middle market has always been companies with EBITDAs of 30 million euros up to, I would say, 100 million euros at the top end. But our sweet spot tends to be companies with EBITDAs of around 50 to 75 million euros. So we're talking about regional champions, maybe pan-European companies, global companies in some instances. So what we're looking for is kind of diversification of the revenue streams and less of a focus on a specific country, and therefore less susceptible to issues that are specific to, say, Italy or the UK that you were talking about earlier.
We would have been good in separate rooms. I think we would define it in a very similar way, yeah. 30 million to 100 million of EBITDA. You think about the market today where most transactions trade at 10-ish times, so that's sort of 300 million of value to $1 billion of value. And so leverage on that's about half, so a little bit smaller than what you heard from the last panelist, so sort of 500 million of leverage on down.
I mentioned in the last panel, and we talked about it toward the end, that we're late or later in the credit cycle. I presume that neither of you would dispute that.
No.
No. So given where we are, you would?
I wouldn't dispute it. It's just that the credit cycle is kind of referred to as something that's global, and I would suggest Europe may be 2 to 3 years behind the US. I mean, if you look at the US, they've had, a good 10 years of solid growth. And quantitative easing started about 10 years ago. Europe's a little behind.
Right.
And we had our little mini recession in 12, 13. So while there has been growth, certainly not at the levels of the US. So I would suggest we're slightly late, earlier cycle than the US, but we're all preparing for that late cycle feel.
You've helped me to get precisely where I wanted to be, which is at this point in the cycle, and specifically with reference to Europe, what kinds of returns do you believe you can confidently generate across your credit portfolio?
Well, it depends on, so it depends on what your risk return is, and we cater to different risk return appetites. So we have funds and vehicles that cater more to a senior-focused fund, and those investors are looking for anywhere from a very conservative 5% up to, I would say, 8 or 9.
Unlevered.
8 or 9, you'll have some leverage.
You have to have some
Yeah.
leverage, okay.
To the more subordinated debt funds, and we've been a subordinated debt lender in the European market for 18 years now, and that we're talking about low-digit returns on an unlevered basis.
Low double digit.
Yeah.
Yeah. And you, Dwight, how would you, and what is GSO looking for here, and how would you compare that to the kinds of returns that you think are reasonable in the U.S. market today?
Well, I think you have to deconstruct it a little bit. So we are clearly late in the cycle. We are later in the U.S. Than we are in Europe. The U.S. rates are on their way up. Quantitative tightening is happening. We're just beginning that process here. So in that world, we think it's appropriate to be defensive in credit. And so there's high yield. You heard a little bit about this in the old panel. High yield, fixed rate, 5-year average duration, yielding today 6.25% on average. You've got floating rate leverage loans that are yielding about the same thing, senior secured, very low duration risk. So our view is you shift from here to here, and you can be defensive even if you believe you're late in the cycle. And we see that in our portfolio. A significant amount of the growth we see in our portfolio are institutional investors making that shift from fixed income to floating rate. And maybe it's in direct lending, but quite often it's in leverage loans. And that, I think, is a place that you can kind of square the view that you want to be defensive with the view that you have to invest.
I have to, sorry to interrupt, but I completely agree with that. That's absolutely what we're seeing too.
There's no question that in a rising rate environment, it is more defensive to be floating than fixed. But again, and it does depend on how high rates do rise. And this is not an issue here in Europe yet. It may become an issue in the United States. You're underwriting credits with what, if you will, margin of comfort or safety. Rates can rise as high as what before it becomes a problem for your borrowers?
I'll give you some numbers. So we have, when we look at our middle market where this exposure exists, certainly in these floating rate companies, and they're smaller companies, so we worry about it a little bit more. So we did a deal earlier this year for a middle market company. It was a private equity sponsored deal. Let's say it was 10 times purchase price, 5 times leveraged, LIBOR plus 675, so call it 9.5 type return profile. We always look at our investors with a forward curve. We use the forward curve for LIBOR, which is today around, 3% for a 2 to 3 year forward curve, 2.4% today. So you've got some embedded growth or rate increase in there. And then we shock it with 200 basis points of LIBOR increase or spread increase or something. So higher cost of capital by 200 basis points. In that particular case, it took the return for the private equity firm from 17% to 16%, and it took their multiple of invested capital from 2.15 to 2.0. So not significant. Now, you might ask the appropriate follow-on question, which is, what if that means their exit multiple is lower and all that kind of stuff? That's hard to model, and that really depends on why you get to that higher rate environment. Is it inflationary, in which case these companies do better, or is it stagflation, in which case everybody is a little challenged by that?
So that's how you price for the uncertainty, if you will, in a rising rate environment.
Yes.
Here, right, the uncertainty factors are different.
Indeed.
How do you price for the uncertainty of Brexit?
Wow, that's a good question. Well, firstly, we're very selective about the companies that we invest in. And a company that has a large UK exposure is one that we're going to be very cautious about. We have typically not been large lenders to the UK over the last 18 years. Our focus has very much been on the Nordics and German-speaking countries, which are the large exporters in Europe. And it's to the point I made earlier. When we're looking at companies, we're looking at their revenue base, their exposure to different countries and jurisdictions. And in terms of our existing portfolios, we do monthly reviews across our portfolios on all of our credits. We've gone back with questionnaires to each one of the managements of our underlying portfolio companies to understand what they see as their exposures to Brexit, what the contingency plans are, et cetera. And the good news is every single one of our portfolio companies has come back and they all have plans.
I invoked Howard Marks, as you know, the last panel. He titled his most recent memo, the 7 worst words in the world. Do you know what they are?
Different this time.
Too much money chasing too few deals.
Yeah.
Although this time is different is a good one as well, but it's not 7. Do you make the same observations that we heard that Howard makes and Tony and Mike seem to agree with, that there isn't just too much money chasing too few deals, it's also too much new money chasing too few deals?
I don't really agree with that. There's certainly circumstances where the competitive dynamic is poor, and you just have to walk away from those situations where you have too many people who are trying to put money to work for whatever reason. But in the last decade or so, leveraged loans the amount of leveraged loans outstanding have increased by double to 1.1 trillion in the U.S. to 1.1 trillion dollars. High yield has increased by 50% to 1.5 trillion dollars. The direct lending business has increased to $200 billion or so, depending on how you measure it. And so the market has increased as these new new strategies have come into the market, and it's really been a bit of a shift away from other investment alternatives. So away from fixed income, traditional high-grade fixed income. So I don't see the same money-chasing deals across our platforms as I see, as we would have felt we saw in 07, 08.
I think it depends where you are in the market, and we've defined this very large mid-market. But if you look at the fundraising here in Europe, the vast majority of that has come for the direct lending funds that are looking at the unitranche product. You heard Ares, you mentioned, just raised $6.5 billion. That skews those numbers quite significantly. So the large fund, I think you guys just raised $20 billion. So I mean, we're talking about 2 or 3 very large funds that are going to skew the numbers. They are looking at a different product to what we're looking at. And in that, I would agree. The market has certainly been growing. The demand for the product, the number of deals, we're seeing that growing. And it depends where you are in the market and what the competitive nature is. We find there is still a lot of deals out there to be selective from. And I would agree, we're very much credit-based, and we will walk away. And we've walked away from more deals over the last 12 months than we have in the years preceding that. So there is still the ability to be selective, especially when you've been in the market for a long time and you have the deep relationships with the private equity sponsors, which is where we get our business.
So given the fact that you do walk away,
yeah.
What about the things that you don't walk away from? Tell us a bit about the industries or the slices of the capital structure, or perhaps even the regions where you feel there is relative value to be found or pricing power.
Yeah, well, to your earlier point, while it's difficult to predict when the cycle's going to turn and how that's going to happen in Europe, we very much manage as if that is going to happen. So we're very defensive. We are through the cycle. And I think as a private credit manager who is basically managing investors' money for 7 to 10 years, it's a little bit ridiculous to suggest you can time the cycle. You just have to manage it. So defensive industries is key. It always has been. So in our portfolio, you will see healthcare. You will see software businesses with a B2B element, with subscription-based type business. What you won't see is retail, automotive. There are obvious industries that we have consistently stayed away from. That would be in an upcycle as much as it would in a down, to be honest. At the end of the day, we're credit. The best we can do is get our money back in interest. So we're not looking for the next big growth company, because that doesn't help us at all. What we're looking for is stable, steady as you go, nice growth. Our companies do perform very well. On average, our portfolio companies have a growth of just under 10%. So very good in this climate. But we're not looking for the next turnaround. We're looking for stable, defensive industries. In terms of jurisdictions, as I mentioned before, the Nordics, German-speaking regions are great because they are large exporting jurisdictions, so you get that diversity of revenues. And that's where we see the value across the cycle.
Dwight, GSO has a much bigger geographic footprint. I could ask you the same question about Europe, and please answer, but beyond Europe.
Well, we're strange. We have strange views about all this, because we're really talking about an economic cycle. It's really the market cycle that drives our business as much as anything. We have not really had a correction in high yield since early 2016. So we're getting,
and that was brief.
And that was brief and very specific. Energy drove that downturn. we have $20 billion of capital in drawdown funds that we can invest in a downturn. So we have these Dr. Jekyll and Mr. Hyde kind of personalities. We want a correction because it creates great opportunity for our strategies, and we build our fully invested strategy so we can survive that and continue to invest those strategies as well. So while we sit here and we talk about how late we are in the cycle, to some degree, we think it's healthy to see the market correct a little bit, particularly with all the noise in the market today. So we watch for that. On sectors, a good example of where we see opportunities is where that has already happened. So energy is in the middle of that, or middle, late, some stage of that process, having 4 years of a significant correction coming out of the energy, out of oil falling in 2014. So you can find these pockets, and Nicole's right, the pocket that you could have found was retail, and if you found it, that was a pocket that kept dropping and dropping. We did not do that because it's in a secular kind of decline that's hard to deal with. Energy is more of a cyclical decline. You can invest that as a credit investor, and so the world gives you these opportunities, even if you're in this period of growth.
Here's a question from the audience that's going to force you to put the Blackstone hat in one hand and the GSO hat in the other. Since you mentioned that you've got this $20 billion, access to $20 billion of committed capital, what's more oversupplied with dry powder, private equity or private credit? And if you had to pick one, which is a better bet?
You're not going to be surprised by my answer, which is I think the opportunity in both is very good right now. We're seeing on the private equity side, you look at Thomson Reuters, it's a unique ability to have significant scale and go do a transaction that many of your competitors can't do, which we think is going to be an extraordinarily successful transaction for private equity. So you can focus on the fact that these large funds exist, but you have to also recognize the fact that those large funds give you the opportunity to make investments that are unique and valuable. I'd say the same thing on credit. Certainly there is new entrants into direct lending. I would actually say the mezz business is flat to down somewhat over the last 5 years. Not as much new competitors coming in, and so depends on where you're playing. Leveraged loans certainly seeing growth, but that is driven by the fact that you are seeing larger and larger private equity transactions. The average leveraged loan 20 years ago was $150 million. Today, this year it's going to be over somewhere around $600 million. So you need that capital to make the transactions work today.
This is a question a little more specific to GSO perhaps than to MV, so I'll start with Dwight. Whether you do or do not agree with the premise of Howard's comments, there's no question a lot of money is coming into private credit. And you mentioned a couple of weeks ago at Blackstone's Investor Day that GSO will raise more capital in 2018 than ever before. So how do you deploy that much money without joining the race to the bottom, if you will, in underwriting standards or the terms at which you lend?
Well, let's think about where that capital is being raised. So in our distressed fund, where we will have a very large drawdown distressed fund that focuses on credit. Think about the conversation. The whole rest of this conversation is all about being ready for that correction that comes. That's our largest distressed fund we've ever raised. It's sitting there in dry powder. We're in the process of raising an energy fund in a market that is dislocated today and gives us unique opportunities. We also raise capital in a sort of liquid strategy that's designed to jump in when the market gives us opportunity and a correction. So we're raising that capital in the context of the world we live in, not in the context of the world we used to live in. And I think that's how we have to run the business.
Nicole, what about MV? Where do you've already expanded the range of credit markets in which you're active. As you think about raising more money, where do you anticipate, trying to appeal to investors, and ultimately, where do you anticipate deploying that capital?
So I think from our perspective, we are very much a company that's stuck to its knitting for the last 18 years. We know our space very well. The European mid-market is a market that we know very well and that knows us very well. We have operated very successfully in that. What we've done in expanding our range of products is to lend across the capital structure where we started life as a subordinated debt lender. So that's what we do. So we now are able to offer our private equity clients a range of solutions across the capital structure, and in turn offer our investors a range of products depending on their risk return and where they see things. So that's where we are. As Dwight mentioned, we also look at credit opportunity funds. We are less comfortable with the distress side. From our perspective, we like performing companies. That's where we like to do business. But we have seen dislocations and pricing anomalies when the market goes down, even in performing companies. That's where we think we can add value. So I think from our perspective, this market has a lot for us. We are not, kind of raising the 20 billions, et cetera. We very much size our funds by what we believe is the right level for us in this market and for our strategies. So we don't have the pressure of deployment. We make sure that we continue to be selective and give those returns at the kind of expense of not growing AUM in quite the same way as some of the other asset managers.
To follow, here's a good question from the audience, and it's for you, Dwight. MV is a standalone credit provider, and by virtue of that fact and that it is not in other alternative asset classes, doesn't ever really run into the question of conflict. This question has to do with that. Does GSO ever face concern from the sponsors whom you provide financing to, that there is an embedded conflict given the fact that Blackstone also happens to run a huge portfolio of private equity, among the largest in the world, the largest real estate portfolio of any alternative asset manager, and a growing list of other things in which you're active?
That's a great question. We spent so much time...
And not the first time.
Not the first time. We spent so much time worrying about that issue a decade ago when we did the deal with Blackstone in 2008. By the way, we did the deal with Blackstone in March of 2008. You might remember what happened shortly after that, so our timing was good. But we were worried about that. As a matter of fact, we didn't even move into the Blackstone building for 3 or 4 years because we didn't want to have the perception that Blackstone was too involved in our investment process for just that reason. So the OBO firms were comfortable. 10 years later, we don't see that concern in the market today. We made the decision a decade ago that we had to have scale and we had to have a brand that brings investors, brings counterparties to us, issuers to us. And Blackstone was an important part of that because we were able to move from, at the time, 8 billion of AUM to today 100 billion of AUM. We were able to have larger funds that could meet larger demands for capital, and we decided that the risk that we were taking at the time was this issue, and it hasn't shown itself to be true in our business.
There's another related question I'm going to ask it of Dwight because I think it makes sense in the context of this part of the conversation. Dwight, another question you've heard before, but it's a good one. GSO has on occasion pursued more aggressive strategies than much of what we've been talking about, direct lending, private credit. This person is specifically thinking about the Hovnanian CDS trade. How are you positioning the GSO platform going forward? Do you consider yourselves to be more of a lender, with all that's implied in that term, or a credit hedge fund? And
did you send that email to yourself?
Nope, it's right here.
Check.
So I want to just for the audience's benefit, Hovnanian is a home builder based in the United States. We did a transaction with them earlier this year that was controversial because it had a credit default swap aspect to the transaction. But I want to highlight one thing about that because the question is true. Our whole business is about providing capital to companies. And I want to highlight that we didn't go buy Hovnanian credit in the market and then buy CDS. We gave significant capital to Hovnanian, who was a longtime customer of the firm, because they had maturities coming up and needed that capital. This is a business that was still recovering from the 08-09 crisis. And so we did do what we do, which is provide capital to the business. We tried to use the CDS markets to protect our return on that capital. But I wouldn't say anything about that is different from our strategy, and we'll continue to do that.
I'm going to finish with this question for the both of you. In the last panel, we talked briefly about Italy. I asked you a question about Brexit, but I'd like to know from both of you, as you sit as credit providers, right? And as you mentioned, Nicole, it's about the return of capital as much as it is about the return on capital. What do you consider to be the biggest risks going forward? What are you paying close attention to? What, if you will, are you worried about?
Well, look, we've talked about Brexit, so I won't bring that up. For us, we think that is the biggest unknown and the area that we're being most prepared about, if you like. The other geopolitical kind of issues, you have to watch constantly. As I said, I think we feel by continuing to have diversification across jurisdictions, across the less cyclical industries, we prepare for those things. I think it's very difficult to specifically target, a potential issue. And Italy is not an area that we lend to particularly. But the knock-on effects are certainly something that you have to be very cognizant of. And that's something that we do in the way in which we underwrite, in the way in which we monitor things every day, every month.
Dwight?
I think Nicole said it very well, which is our strategies do well by not doing badly. As long as we don't lose money on investments, our strategies will do well. So what worries us the most, not Brexit, not what's going to happen in the near term. As a matter of fact, to some degree, a hard Brexit is interesting to us because it might create market disruption. What worries us is this fundamental disintermediation that's going on in the market with technology and with new forms of business. And so the Amazon disruption, if you will. As a credit investor, if you invest in a business that you think is a long-term cash flow business and its business is disrupted, all of a sudden that asset base that you loaned 50% against, you could start losing money very quickly. And you saw that in the Toys R Us bankruptcy. And so when we sit in our committees, that's what the conversation is about, is are we wrong about that particular issue? Because if we are, there's no getting it back. You can't go fix that problem. And so that's where we worry more than anything else.
With that, please join me in thanking Nicole Downer of MV Credit and Dwight Scott of GSO.